So I just wanted to make a quick reminder to everyone out there that real estate isn't just square footage. It's not Zillow stalking. It is not cruising and trying to flip a home with nothing behind it. It's not flipping a house for a quick check or waiting to see if maybe the interest rates change or the market is going to rise. The truth really is the money that is behind it, at least the real money in real estate, is hidden code. Every serious investor, every realtor with more than just a side hustle maybe, every family building wealth, they're not playing the game just of appreciation. They are using depreciation, cost segregation. They are doing exchanges, credits to make the IRS bankroll their next move. And if you don't know how to play this game, you're not just leaving money on the table, you're paying for someone else's empire. Welcome back to Spicy Takes and Tax Breaks. I'm your host, Aubree Denekamp, better known as the Write-Off Queen. Today, I'm making you inside the strategies baked within the property ownership world, the ones that create cash flow, fund new projects, and make the IRS your silent partner. We'll hit depreciation today, cost segregation, 1031 exchanges. We'll go through the new big, beautiful bill and how to flip the tax code into your favor. If you don't know how to use the tax code to your advantage, you're basically, like I said before, subsidizing everyone else who knows how to use it. By the end of this episode, you'll see why real estate is the single sexiest wealth strategy out there and how to start making it work for you right now. So before I lay out the basics, I also get pushback from prospective clients on this single question. It sounds too good to be true. Am I going to get flagged by the IRS? I'm not here to cheat the system. I do want to pay my taxes if I'm doing well. I get it. We've all been so trained to think that we're saving big on taxes or that we must pay on taxes if we're making big money. And we must do something shady to negate that, essentially. That's not true. What if I tell you the system is actually here to teach you how to do this or utilize you for this purpose? It is the system. The government actually wants you to invest in this property. Why? Housing fuels the economy is the number one reason. When you buy a rental, you're providing a roof over someone's head. You're hiring contractors. You're paying property taxes. You're pumping money into the local community. And the IRS is not mad about that. They cannot afford to do this in every single community. They literally wrote so many pages within the code book that go over this and explain why and how this is working for everyone. Here's what that means in plain English. The IRS pretends your property is slowly falling apart, whether it is or isn't, even if it's actually going up in value like the housing market has, historically at least. They let you write off a slice of that property's cost every single year. So historically, for residential rentals, it's spread over 27.5 years. For commercial properties, it's over 39 years. So let's try and put some real numbers on it for you. If you were to buy a $275,000 rental home, every year you get to take roughly $10,000 to $15,000 in depreciation as a tax deduction. That's $10,000 off your taxable income, whether you actually spent it or not. It's a rental property, you're depreciating it. And that's where the magic hits. Imagine you're making $500 a month in positive cash flow off this rental property. That's a $6,000 a year, let's call it in real money, in your pocket as a profit. Normally, you'd expect to be taxed on that. But thanks to depreciation, your tax might show a loss, even if you're claiming $6,000 in revenue that's profit to you. You're also taking that $10,000, $15,000 depreciation off the top for the next 27.5 years with this method, even while you're literally cashing rent checks on a day-to-day or month-to-month basis. This is why any seasoned investor that's going to walk around saying, hey, my rentals pay me tax-free, they're not exaggerating in the sense of the method they're using is not tax based on how they're using it. It's depreciation at work, essentially. But I want you to really think about that specifically. The IRS is telling you, okay, invest money, borrow money. Here's a deduction for every single year moving forward, just owning a damn property. It's not that risky, specifically looking at housing markets. If you have any sort of hold time that you can use, it's the code doing exactly what it's designed to do and to prompt people and motivate them to do it. All right, so depreciation is good. Don't get me wrong, but here's where it gets actually more exciting than just what depreciation is doing year over year for you. What if I told you instead of waiting that 27.5 or 39 years to collect those write-offs, you could actually grab a huge chunk from that right up front, like within that first year of purchasing it? That's where the real strategy comes in. Typically, cost segregation, even if you purchase this in the past without 25, 26 moving forward years, we can actually retroactively do that without amending returns. So we can do a follow-up on that next. But here's the deal. When you buy a property, the IRS doesn't see it as one giant house or building. They're seeing it as essentially pieces or different actions that are going to be depreciated. So there's different buckets. Let's call each bucket a different speed. 5-year stuff would be like appliances, carpet, tiling, cabinet, um, granite tops. 7-year stuff would be furniture, so desks, couches, chairs, conference tables. 15-year stuff, we'll move forward to that. It's like parking lots, landscaping, outdoor lighting. You have retrofits all over, whether it's interior or exterior for all LED. You got solar put on your roof. Any of those things would be considered within that 15-year depreciation schedule. Normally, you'd be stuck dragging those deductions out for decades. So again, 27.5 years or 39. But with cost segregation, what we can do is we can slice and dice your property into these different buckets and pieces and utilize those all on a shorter life asset into kind of the spotlight. But depending on where you're at in revenue, essentially we're going to slam them with bonus depreciation. So let's go through this with real numbers. A client of mine recently actually, let me try and think about what it was. It was, I think, $1 million in a commercial property. It was just over that, but let's call it $1 million for straight numbers. We did straight line depreciation. We didn't, but that's what he was recommended. That would have given him $25,000 a year, which that's great. You're still getting a write-off. That's significant and amazing. Not bad. But with cost segregation, what we're doing is we're accelerating over 300,000 of that $1 million into that first year. That move alone wiped out all of the rental income on paper, even the ones that were sheltered over other income, in a huge way for this client specifically. But something that we want to be making sure is every property, whether we're looking at $1 million or a $200,000 property, you can do this cost segregation with it. So they still pocket the rent checks, still have cash flow, but their tax return, it shows a loss in the power play move of saying, hey, we're depreciating an asset we still have. So for borrowing power, you're still at a good place, but you're not actually having to pay that tax bill. So an update that's kind of happened with the big, beautiful bill is going to be one of my most favorite is 100% bonus depreciation. It's permanently back for property placed into service after January 19th, 2025. What does that mean? Every realtor, every investor just got the biggest green light, accelerate deductions like crazy. It's not a small change. This is huge, huge, huge tax change for anyone using it. It's not a 6-figure small move for most people. It actually accelerates way beyond that for a lot. But if you're not running this cost segregation study, you're playing checkers while everyone else is playing chess, essentially. You're missing so many different pieces, but on a huge accelerated level that would take you at least a decade to recoup. Another one here is the 1031 exchanges. It's one of the oldest, one of the juiciest, I guess, moves in the book. What you're basically doing here is you sell one property, roll the gain into another, kind of like a like-kind exchange, and no capital gains. It's great. None that are due today. So an example of that would be you bought a duplex for, let's say, $300,000. You sold it for $500,000. Normally that picture looks like a $200,000 gain. That's pretty darn big tax bill. It's going to hit you right in the face right when you sell the property or within that year's tax filing. But if you do a 1031, what you're doing is you're rolling the profit from that sale, say, into a $700,000 fourplex. There's zero capital gains that are due today on that money. You level up your portfolio without cutting any checks to the IRS by rolling that money into your next investment, your next future for that wealth. The kicker here is that the ones who are doing this correctly, they rarely are cashing out those profits. They're exchanging them, they're rolling them property after property, snowballing what is growing in their bank account and what they have asset power over. Then, when they pass it on, their heirs get a step-up basis, proof, meaning all of those deferred gains vanish. It's not just a strategy, but it's also how you can plan how you want to save for the future. Most people want to provide a legacy for their family, whatever that looks like for them. But this is a way that you're planning and providing while benefiting your current day life, leaving them this tangible asset without any tax that's going to be hit on it. And you're building something without actually having to put into special funds or CD accounts or whatever investment route you're going. Interest and deductions. So we don't want to ever sleep on these classics. They sound boring, they sound old, and kind of what everyone's been doing, but really we are printing money here. Mortgage interest is fully deductible, property tax is fully deductible, any sort of insurance, repairs, upgrades, management fees, mileage from your rental, going there, checking on it, traveling there if you live out of state, all of that is fully deductible. Every single one of the contractors that you invoice, whether that is a cleaning person, whether that is someone to go out and check on your property monthly, all of those things, target blind runs, those are all going to be chipping away at what you're taking in for that rental income. And we want to make sure to monetize on that alone before we get into what's really making your money. What's new under the big, beautiful bill with this is that the interest deduction just was increased. So the formula that they're using to limit interest deductions was widened. Basically, what that means is you can deduct a bigger strand in your financing costs instead of losing them. So leveraging got more attractive in this sense. So you're taking that bigger deduction without actually chipping away at your borrowing power. All right, so let's get quickly going to jump into the affordable housing credits. In my opinion, it's one of those gems that just doesn't really get enough talk about. Like, it can do a lot for you, but most people don't do much with it. So under the big, beautiful bill, states are getting up to 12% permanent increase from these. And this starts actually, I believe, 2026. But basically, the bond finance projects that qualify for the 4% credit, they're going to have a lower threshold now. If you're a realtor working with any sort of developer or you're a developer yourself, you've ever considered stepping into that affordable housing project world, this is the time to do it. The returns are so much higher and better right now. It's going to have such a social impact that you get to feel good about. So you're building your wealth while also helping solve this huge housing crisis that we're in. It's legacy level stuff. You want to be in on it if that is the direction you're looking at. I definitely recommend taking a look again now if that is on something you plan to do. So, quick recap on the spicy updates from the new law that matters to property owners right now. So, 100% bonus depreciation is fully back. You can accelerate deductions like crazy here, whether that is within purchasing, upgrades, anything you're doing. Section 179, expensing limits are permanently higher. Write off more, faster, quicker. You don't have to wait year over year for them. And we also have business interest deduction, which is so much more expanded, more loan interest, and that equals fully deductible. Incredible. Low income housing credits, they are now higher, doing bigger allocations, easier to qualify for. And kind of a phantom income rule with condo developers, it's no longer there. There's no more paying tax on money you never actually received. So the bottom line here is if you're owning, improving, developing property, your tax efficiency has just gone through the roof. So I know this can feel like I'm just firing you guys with the water hose, but if you own a property and you're not using these strategies, you're so overpaying, period. I'm not saying that you need to hire a cost segregation engineer tomorrow or start developing affordable housing today. But what I'm saying is run the numbers. If this is something that might be in your future, I want you to take a look at it again. See if that makes sense in the next couple of years or how you can start growing to that point. So I know what's sitting on the table before you write your next check to the IRS and start really strategizing around that. See if it can make sense. I've seen clients save upward of $500,000 a year on strategies like this just because they structured it correctly on things they were already doing or already spending the funds on. That's money they reinvested into more doors that are making the money they used to pay down debt that they already had, money that's putting their kids through school and brought back their time. But also, it is creating an entire legacy for what their kids can do next in life. This is not loophole hunting. This is tax code written to reward the people who build and own properties. If you're not playing the game, you're subsidizing the ones who are actually playing. So here's your takeaway. Real estate taxes, it's just not about the deals you're closing. It's about strategy and how to make that work for you depreciation, cost segregation, 1031 exchanges, interest deductions, housing credits. Big Beautiful Bill has expanded these, like I said before, hugely, so make sure we're using them. The IRS right now needs that assistance, so they are paying you and incentivizing you to do so. So I put together really quickly a real estate tax hack guide. It also has a mini calculator in it. It's completely free. You can run your own numbers and see kind of the savings that would be applicable to yourself if you're already in the real estate game. So grab it now at show notes. If this makes sense for you at all or anyone in your circle, don't forget to subscribe, share with your realtor friends, and follow me on Instagram and TikTok at The Write-Off Queen for more spicy takes. Next week, we're going to be getting into audit flags within real estate, the moves that will get you into trouble, and the ones that are going to help you so much when you're doing it right. Trust me, you don't want to miss that one. This is the Write-Up Queen from Spicy Takes and Tax Breaks, reminding you that strategy creates wealth.